With central banks around the world cutting interest rates and spending big on economic stimulus, the cost of borrowing in some countries is hovering around negative territory. In Singapore, a key lending rate is barely above zero. Another has dipped below zero for the second time this year. So what do negative interest rates mean? Well, lower borrowing costs mean we pay less interest on all our loans. This leaves more cash to spend to resuscitate economic growth. It also means that deposit rates will be just as low. Banks could even charge customers for saving. Germany's Deutsche Bank has already started charging some of its bigger clients to deposit funds with them. And the rationale is that with low borrowing costs and deposit rates, companies and consumers will be encouraged to spend more. With negative interest rates, a country's currency will weaken as it becomes less attractive to foreign investors, and that in turn will make its exports cheaper and more attractive. In Singapore, the central bank doesn't set interest rates. Instead, the monetary authority manages the Sing dollar against a basket of currencies of key trading partners, of which the US is one of them. So that means borrowing costs here track those in the US. Speculation that US interest rates could go negative, plus the pumping of liquidity, have pushed borrowing costs in Singapore lower. And the Singapore overnight rate average is now at 0.015%. That's down from around 1.7% in January and at its lowest since July 2005. The overnight swap offer rate last week was at minus 0.045%. And that's the second time this year it's been below zero after reaching around minus 0.6% in late March.